I hope I've got the settings right. Now, good work. Okay, well, while Chris is doing that, welcome everybody. I think everyone's been to one of these before except maybe you, Helen. So welcome to your first Level Up webinar. Of course, you know who I am. And of course, you can see in the top of your screen there, you've got Kristopher Meuwissen from Wealtheon as our special guest presenter today. And he is he's the principal advisor, financial advisor at Wealtheon. And most of you will know this, but potentially this will be a surprise news. Financial planning is relatively close to my heart. Not because it's a type of strategic planning, although it is, but as Chris knows, I've got mum that used to be a financial planner, dad's been in the industry, I'm married to a planner, I used to work in financial planning, I can't get away from it. And so when Chris and I crossed paths a few months ago now, I was really excited about bringing him into sort of the Level Up holistic offering, and we've been looking forward to this webinar for a little while, haven't we, Chris? So it's a momentous day. It's a momentous day for us. So I have seen a sneak peek. I've seen a sneak peek of what Chris is going to take us through. It's incredibly comprehensive, so I won't talk too long. But I will just quickly introduce you to Chris. Hopefully you're all on mute. You all know the rules. If you've got a question, pop it in the chat function. We'll let Chris go on a roll and do his presentation, and then we'll address questions at the end. And I think Chris is relatively open to answering whatever questions you might have. But of course, as we know with the financial planning industry, it's all general advice. So when it comes to this, you really need to have a one-on-one consult if you want something specific to your needs. But if you have a general question, ask away, don't hold back. So they're the ground rules for today, and I think Chris is going to cover that in a minute as well. But quick introduction of you, Chris. So for those who tuned in a little bit earlier, Chris was mentioning that he was based up in Airlie Beach until very recently. I think he's crazy, but he's now moved to Victoria, which is a wonderful state, living on a vineyard, and took the business with him, took his business partners with him, which includes his wife and his dog, and they're about to take Victoria by storm, by all accounts, Chris. So I'm looking forward to seeing what Wealtheon do next. But Chris has been in the financial planning industry, I think, did you say 8 years just before, Chris?
Yeah, giving personalised advice for 8.5 years, but been around for 10, yeah. Been
around for 10. Small business owner, obviously owns Wealtheon, so knows about small business owners, does specialise in advice for small business owners, which is why I brought him in here today, but also specialises in tradies, miners and FIFO workers. So there were lots of them up in North Queensland, I imagine, Chris, but all across Australia as well. So that's Wealtheon. If you are interested in anything you hear today from Chris, Wealtheon do have a 9-step money mastery model, which you can get access to, and we're getting a little bit of a sneak peek of that today. So some great resources for you to take a look at, and of course, we'll hear more from Chris now. So that is Chris, that is our webinar. I'm going to go on mute and hand over to my special guest to teach us all about how to turn business profits into personal assets. Thanks, Chris.
Yeah, all right. Thank you, Jasmine. Thanks for the introduction, and thanks for helping me put all this together. As I'm sure you're all aware, if you're working with Jasmine, you know just how energetic and absolutely lovely she is to deal with. So, big thank you to you as well, Jasmine. Today is all about how to turn business profits into personal assets, and we're going to be covering off stuff in more high level way today, because sometimes these things can be very, very complicated, and so we're going to cover things off in high level. But if you have any questions, please do let me know, and we can get into a little bit more nitty-gritty later. And if you have any personal stuff that you want to run past me, happy to jump in a 15-minute chat or whatever it is, and go through those with you as well. So quick tech check, just make sure that you can all hear me. I'm assuming you all can. If you can't hear me or if something's going wrong, let me know. And just to let you know that everything that we go through today is general in nature. So we're not taking into account your personal circumstances, and that's really important for you to know. So everything that we do talk about is only general information and general advice. All right, so welcome, guys. tell you a little bit about me and why you should maybe be listening to me and what makes me a bit of an authority in this space is I've been giving advice for a long, long time, 8.5 years, as Jasmine said. And advice has been dinner table talk for me as well, Jasmine. So my parents had a financial advice business for my entire life. Now, 8.5 years and I'm 28. So I'm a young financial advisor. I've got a big focus on technology as well as a big focus on what we call goals-based advice. And as Jasmine mentioned, I've created a Financial 360 program, which is involved with a money mastery model, 9-step money mastery model. And great news that came out on Friday is I've actually just been recognised as a national finalist for Goals-Based Advisor of the Year and also the Innovator of the Year for the Money Mastery model, which is held by Independent Financial Advisors Excellence Awards. So that's a little bit about myself. In terms of the Money Mastery model, we're going to touch on this very briefly. It's all around taking together my last 8.5 to 9 odd years worth of experience in giving personalised advice and putting it together in a way that allows me to have some scale in terms of the advice that I give, but really allows me to help identify clients' issues and have the clients self-identify the level of advice that they need and the type of advice that they need. So that way there's not a situation where a client ever feels pressured or a client feels that they've had anything missed. So we cover off all the different areas of advice, as you can see here, the 9 different areas of advice that we can go through, and we ask pointed questions so that way we can get to the identify goals and make sure that the advice is structured towards those goals. Overview for today, we're going to cover off 3 things. First one's going to be around investments. The second one is going to be around structures. And the third one is going to be around compounding and gearing. And I suppose it's called the tortoise and the hare. We'll go through that in a little bit. So starting off with module 1 and what assets are right for you. So first thing that we want to go through is what do we mean by turning business profits into personal assets? Because there's a lot of stuff that we can cover off with this. And what we mean specifically is that business owners are often so focused on their business and growing it that they actually forget to build assets outside of their company. And they end up having their asset being the company and they're funneling so much money, so much time, so much pressure and so much effort into it that some of the other stuff goes by the wayside. So usually business owners are only really paying themselves enough to live and get by, which means that they're often putting all their eggs into one basket. This leaves a fair bit of risk, especially if they're planning on selling their business and that's their retirement plans and those sorts of things. As business valuations change and different things happen, goodwill isn't always so good. So we want to make sure that we're getting those business profits into personal assets. So why is it important? Well, it's important to create personal assets to reduce your risk and create real and new opportunities for you. As business owners, you're taking a lot of risk when owning a business, and having personal assets is realistically a backup plan. It also provides you the foundations for a succession plan, which I just touched on, without you having to rely solely on the sale of your business. So getting into module 1, the different types of investments. So as you guys, as business owners, are well aware, there are so many different ways that you can invest and so many different things that you can invest into, whether it's plant and equipment right through to art and classic cars. But there are a number of investments that are, in essence, really available, readily available, and tried and tested ways of securing wealth, reducing risk, and growing wealth over the long term. So we're going to run through what I call the investment quadrant, and we're going to work out what sort of assets are right for you. Now, there's no right or wrong answer when going into this. This is all about understanding what is right for you and working out the right investments for you. And the right investments really need to cover off things such as how long are you going to be investing for, when you're going to need the money, investments that you reasonably understand, as well as investments that you can afford, and investments that don't overextend you. So going to the investment quadrant is 4 major areas as financial advisors that we really have a look at when we're looking at investing. It's cash, it's fixed interest, it's shares, and it's property. Now, there's lots of different forms and fashions within these different areas, but these are the major 4 areas that we look at when we're looking at investments. Now, you might be wondering, well, how do I actually make money from some of these investments? And there's 2 ways to make money from an investment. There's income and there's growth. Now, if you're wondering what income is, well, income is essentially like the rent paid on a property, or the profits from a business, or the dividend from a business. Growth is the value of a property, and the value of a business, or the value of shares. So there's two major ways to make money when we're looking at these different assets. So let's quickly run through and have a look at some of the expected returns and some of the ways that these different assets actually perform. So first, we'll start at the top left of the quadrant. We'll start with cash. Now, before we get into the income and the growth of cash, there's a couple of reasons why we really like cash. Number one, we love cash because it's safe and secure. We love cash because it's a liquid investment and we have ready access to it. And we love cash because it doesn't really vary in the amount that you have in your bank account or access to, unless you go and spend it. So what's the trade-off for that? Well, the trade-off with that is that you actually get, in today's environment, a really low rate of return, anywhere between 0.1 and 1.5%, depending on the type of cash account that you're looking at and whether or not it's a fixed term deposit and those sorts of things. So it's not a great return, especially when you take into account things like inflation. You can often be going backwards when you're actually considering things like investing in cash. Now, one of the pluses and also one of the downfalls of cash is we are guaranteed no growth from cash. So again, we like that from a safety and security point of view. It's great as a holding or a liquid asset, but if you want long-term great results, cash probably isn't your friend in the long term. So moving on to fixed interest. When we're having a look at fixed interest, we're talking all things corporates and government bond markets, right through from treasury bonds through to businesses organising debt. And that's essentially what it is. Fixed interest is almost like a debt bill. And what happens is essentially corporations and governments are raising money to be able to spend and improve their corporations or governments in ways that they see fit. Now, generally speaking, with these, you're seeing between 0.5 and 5% income when you're looking at these fixed interest type products. Anything higher than that, and because there is fixed interest that is available with higher than 5% on income, but in today's environment, that's starting to push into what we call junk bond territory. Now, if you're wondering what a junk bond is and what it actually means for you, it's the kind of bond that is unlikely that is going to be able to pay you back over the long term. Generally speaking, when we're seeing a higher rate of income and we're seeing a higher return on fixed interest, it's generally the riskier type of fixed interest or bond. Now, a few things that add to the risk with fixed interest is the term of the bond. And so the longer the term or the longer the amount of time that you're in the bond, the greater the chances that the corporation or government isn't going to be there to actually pay you back. So a 30-year bond is actually going to pay you more per year than a 12-month or a 6-month bond will. And also, obviously, the viability of the institutional government that's actually providing these bonds. Now, for example, US Treasury bonds and Australian government bonds have an extraordinarily high likelihood that they're going to be able to pay you out over the long term. Whereas if you, bought, for example, Thai bonds or something along those lines in developing nations, whether or not, or Fijian bonds, that government is going to be there in the long run to actually be able to pay you back is a different story. So we have an okay amount of income from these guys, and these are what we call our defensive type assets. Now, we're also guaranteed no growth with fixed interest, but there is an ability to see values change. And I'll go through what's called interest rate risk in just a moment, okay? Now, when we're looking at growth style assets, which is what we call shares and property, we have a look at these in essence, they're a little bit more curious in the way that they behave, because as business owners and people who work in business, you'd be aware that if you own a business, you don't know exactly what your income is going to be, right? Your income is whatever the profit of the business is going to be. So there's a bit of a question mark around income. There's a question mark around growth. Now, we don't have a crystal ball. We don't know exactly where the growth is going to be. I don't know what the growth in your business is going to be, and I don't even know exactly what the growth in my business is going to be in the next 2 days versus the next 100 days or the next 12 months or whatever it is. So big question mark when it comes to income and when it comes to growth. It's exactly the same thing for property. There's no guarantees on it. there's no guarantee that you're going to be paid your rent. There's no guarantee that you can actually get someone in to rent your property at all. And there's no guarantees that somebody is going to be able to buy your property in the future, and there's no guarantees on the value of the property market. And it's influenced by so many things that it is extraordinarily hard to predict. So beware the fortune tellers who are telling you that this property is guaranteed to go in this direction, or that you're guaranteed to get this level of income, because oftentimes they're a little bit of snake oil salesmen. So it's got to be very careful in the way that you look at these things. Now, that being said, these two have been the traditional way of making money for a lot of investors, and we're talking about years of time invested. So average over the last 10 years has been 7 to 9% per annum return over the last 10 odd years. And it's pretty similar over the last 20 odd years. So it's been very, very good growth, especially if you've been owning direct property in areas like Brisbane, Sydney, Melbourne, as well as owning shares in the US in the last US stocks and those sorts of things in the last 10 odd years. Now, there's a few things that we need to consider. Generally speaking, these type of assets, your income and your fixed interest type assets, are traditionally less risk type assets. And your growth style assets are generally higher risk style assets. Now, again, working out what's right for you comes down to a number of different things, such as your ability to purchase an asset. And a really quick example is if you have $10,000 to invest as a start-off investment, going and buying a property is probably not feasible in terms of owning direct property. But there are other options too, such as owning commercial and infrastructure type projects that you're able to get access to relatively cheaply. Same as with shares. Now, shares can range from anything from owning shares in your local fish and chip shop, which you might pay $100 grand to go and purchase, right through to owning some Commonwealth Bank shares, which is one of the biggest companies here in Australia, and the access and the ability to go into and purchase those Commonwealth Bank shares as a publicly traded company is actually quite minimal. It's a very small cost. So when we're talking about interest rate risk, going back to fixed interest, when we're talking about a few of the risks that are involved, we have interest rate risk with fixed interest type investments. Now, a really easy way to explain this is if you guys have a 10-year fixed interest type bond, and we're using really easy round numbers here, and we have a $100,000 investment, 1% means that we've agreed to get a $1,000 per annum return over a 10-year period. Okay, now that's all good and well, and you might say, well, that's an okay investment for me. That's what you've decided to do. But let's say interest rates go up. Let's say they go up to 2%. Now, what that means is that you guys are holding on to that 10-year bond at 1%. Now, the next year, I can come in, if interest rates have gone up to 2%, and I can purchase the exact same type of bond, and I can purchase it and get the exact same return as you for half the amount of money. Now, that's not an issue so long as you don't need access to the capital and you're not selling those bonds. But if for whatever reason you do need access to the capital, you need access to those bonds, you might have to take a 50% haircut to be able to get rid of them, because no one else is going to purchase them because they can get a similar bond or the same bond at a much better rate anyway. All right, so let me know if you have any questions about that. And the reason why I touch on this is because when we're looking at less risk and traditionally a less risk type of investment, we say, okay, well, that's all good and well, but where are we globally with interest rate cycles? Now, globally, we're towards the bottom, and we've actually seen interest rate risk go the other way, whereas interest rates have fallen, people who have been holding onto these longer term bonds with higher interest rates have actually been able to sell their bonds and actually potentially make some money because other people want the less risk over that period of time. On the other way, now we've had a falling interest rate since 1992. On the way back out, we might see some extra risk coming through with fixed interest type bonds. So that's another thing that you need to consider when you're having a look at the different types of investments that you're going to be investing into. Okay, so moving on to volatility and risk with growth style assets. Now, I've got this chart here because when we're talking about growth style investments, we talk about investing over a period of 5 to 10 plus years. There's a big reason for this, all right? Now, one of the biggest reasons is short-term volatility. All right, now when we're talking about short-term volatility, if you had invested the day before the 87 crash, or the tech crash, or the global financial crisis, you would have been, over that next 12 to 18 months, you would have been absolutely pulling your hair out, right? You've been wondering how on earth you might have lost between 20 and 50% of your money over the course of a few months. But the reason why we talk about volatility and results, and they go hand in hand with each other, is the market has never failed to beat its previous highs. So it's all about time in the market rather than trying to time the market. And when you guys, as busy business owners and people in general, having the idea of trying to buy in and out of the market sometimes becomes a bit of a fool's game. So it becomes about a case of, well, how long have we got the ability to be invested for, and what sort of results do we need? And that's when we can start to determine the level of risk that's actually appropriate for you. All right, so I might stop there just for a moment. Okay. Does anyone have any questions right now that you have about some of these different investments that I can answer really quickly?
Quick one from me, Chris, I suppose. You talk about time in the market versus timing the market. Is 10 years kind of, I don't know, the benchmark that people look to for a growth investment?
Look, it is one of the benchmarks. It's something that I prefer when dealing with clients. That being said, I would say that if you're going to be allocating money to assets in growth style investments, you need to be able to effectively put those assets, that asset away for at least 5 years. So you want to have a 5-year turnaround. Any shorter than that, if you need money and need capital within that time frame, it's probably better to look at options that don't change in value so quickly. Does that answer your question?
It does, thank you. And I'm guessing as well that if you wanted to do something in, say, 12 months, or even, dare I say the words, short selling, that's a totally different strategic way of investing, isn't it? And that's a totally different ballgame. If you're looking at taking large positions in growth style assets, that is a high amount of risk that you're looking to take, and it's a very specialised way of actually investing. That being said, in my personal experience, short selling and futures markets and those sorts of things, in my opinion, is nigh on gambling. It's taking a punt. It's almost, and you probably actually get better odds going down to the TAB and betting on some horses, or going and putting money on the roulette table. In my personal opinion, it's worked really well for some people, but generally speaking, doing that sort of investing works really well for the professionals who are doing it day in, day out, plenty of capital, and not so good for the average person having a go. Good points. Did anyone else have any questions before we go? Is it module 2 next, Chris?
Yeah, we've got some key takeaways, and then we're going into module 2. Yeah.
All right, let's go.
Great. All right. So the key takeaways when we're looking at these investments is diversification, or spreading investments around, is the easiest and cheapest way to reduce risk without impacting return over the long term. And by that, what I mean is making sure that you have an investment selection that takes into account some cash, some fixed interest, some property, and some shares and share markets, is the quickest way of reducing risk and getting access to a lot of different markets. Now, in terms of diversification, it's more than just asset allocation. It's also around investing within those different markets. So when we're talking about diversification within property, it's great to have a property and it's great to have some shares, but if you're investing in a direct property, it might not be the best idea to invest in a direct property in a house next door to the home that you own. You might want to start investing in property in a different suburb or in a different location to where you are. Also consider different types of properties, such as potentially owning a commercial type of property or something along those lines, as well as investing in things like infrastructure projects. Same goes for shares. So not all shares are created equal. When we're looking at diversification, we want to make sure that you haven't got all your money sitting in one big bank, for example, because if something happens within that bank, there's some poor management or something along those lines, you're taking quite a lot of risk. Where you can diversify across a larger section of financials, or broader markets or international markets or consumer cyclicals, and getting access to getting access to a wide variety of different investments is really cheap and it's really easy as well. So diversification is a really good way of reducing your risk while still getting a great return over the long term. Another key takeaway that I want you guys to think about is invest with the end in mind. All right, so think about your age and think about the return that you're going to need and the actual dollar figure that you're going to need in 10, 20, 30 years. And that way you can start to work out what sort of investments you need to be making today to be able to get there. Another one of my favourite sayings is the best time to plant a tree is 20 years ago, and the next best time is today. Because if you want to have a tree that's nice, big, you know, if it's a fruit tree that's giving you lots and lots of fruit, you want to have it for as long as possible. But if you have no idea in terms of where you need it to be in 5 years or 10 years, then you might end up doing the wrong thing. You might not be planning at the right time. There's a lot of different things that you need to consider. Asset allocation is more important than individual good picks in getting good returns and reducing risks. So if you're someone who it's your first time in the markets, or it's your first time looking at investing, or if you're considering it, what sort of investments you should be making, rather than trying to pull out, I don't know, ANZ Bank as a good buy right now and taking a punt on that, working out whether or not you should be having money allocated towards the Australian share market versus international share markets is a much more important step than trying to figure out where the next big boom is in terms of investing and making a whole bunch of money. Your investments, as a key takeaway, need to match your ability to risk appetite. So you need to have the ability to hold these investments. You need to be able to you need to have the ability to actually put your head down on the pillow at night and not freak out about them. So if you're stressed or concerned about your investments and you're thinking that it's all going to blow up and it's all going to be the wrong thing, then you may need to consider less risky assets and less risky investments. So moving along to module 2. Module 2 is all around structures. Now, once we've worked out what sort of investments we want to look at in terms of the investments that you want to purchase, we need to start working out who should own those investments. Now, why are structures important? Structures are important because ownership is more than just a form of how you have the investment. It's crucial to the investments. Right ownership can help you reduce tax, it can reduce or completely remove risk, and it can give you greater control as well as provide certainty. And the right ownership can also reduce the administration burden for you as well. And as business owners, structure is almost just as important as a type of investment that you're looking to invest into. So what's available to you? Now, there's quite a few that's available to you, and we're going to go through some of the more common ones. Number one is you owning the asset. Okay, you owning the shares, you owning the property, and those sorts of things. Another one is your spouse. There's trusts and companies, as well as investment bonds. Okay, now we're going to go through, and also, superannuation. So these are the most common ones when we're talking about ways that you can actually hold the investments and the different structures that are available to you. There's a few more, but these are the most common. Now, we're going to run through a couple here, and one of the most common is around trusts and companies, which we're not going to go through today, okay? But if you want to have a bit more of a chat to me about them, if you're wondering whether or not it's right for you, happy to answer a few questions a little bit later about it as well. So when we're talking about structures and we're talking about reducing risk, this is one of the number one reasons why business owners should be looking at the type of structure that they're using. And you guys carry a lot of risk. You guys carry a lot of bankruptcy risk, litigation, taxation risk. Okay, so there's a lot of different areas that you guys need to protect yourselves around when it comes to risk, around what you're doing, how you're doing it, and who's owning the asset. Now, that all being the case, oftentimes there is in a partnership, there is an income generator and an asset owner, and I'll go through with you a little bit more about that in a moment. So let's have a look at two major structures that we can utilise to reduce risk. Now, as a business owner, we're going to try and remove you guys as the owner of the asset, because that is the highest amount of risk for litigation, bankruptcy, and those sorts of things. especially if you're the director of a company and you have obligations that you can potentially be personally held liable for the decisions that you make in a company. So the first one is your spouse. If you have a spouse that is a low income earner, amazing. If you have a spouse that is staying at home, it's even better. But essentially, having your spouse having ownership over an asset gives you a few different benefits. One is reduced bankruptcy risk. So if you go bankrupt within your company and you don't own the family home and you don't own the family investments and you don't own those things, the company goes into liquidation. They potentially come after you as personal liability for the director, but they can't actually come across and get these personal assets held in your spouse's name. Okay, so it gives you some bankruptcy risk, reduced bankruptcy risk. There's also potential tax benefits if your spouse is a lower income earner than you are as well. So there's some good benefits there. So what are the negatives of your spouse owning these assets? Well, one, your spouse has potential risks as well. So there needs to be a risk assessment done on your spouse and the ability for them to own the assets. So if your spouse, for example, if you're a business owner and your spouse is a lawyer or a doctor, you might have to scratch your head and go, well, maybe they're actually more likely to get sued than I am. And at which point you might have a look at a different type of structure as well. Another structure that we look at that we come across a lot, and I'm just going to quick sip my coffee, is superannuation. So superannuation is a really common one. It's one that we almost all have, and it's one that often business owners sort of neglect because they don't necessarily have to pay their super, or they think it's something that they can put in a little bit later. So what are some of the benefits of super? Well, the number one benefit of super is that at 65, or when you meet a condition of release, you go into a really tax-effective environment. So tax-effective, you actually are at a zero tax environment, which is absolutely amazing. So superannuation is one of the best tax vehicles that Australians have at their disposal for the average person. It's unable to be touched by bankruptcy, which you're not the owner of your superannuation, you're a trustee or you're a beneficiary of your super. So your superannuation is often protected when it comes to bankruptcy, and it's unable to be litigated against as well. There may be some clawbacks when it comes to bankruptcy and litigation if there's been a huge amount of money funneled into your super in the last 6 to 12 months. But other than that, they can't really come after your super too much at all. Right, so it has some really amazing benefits there. So what are the downfalls of super? Well, one of the downfalls of super is that it's quite complex. People are unsure as to how much they can put in, when they can put it in, and what they can invest in, and how what different superannuation products are available to them and what they should have. So should you have a self-managed super fund? Should you have a superannuation master trust or a retail type fund? Or should you be looking at an industry type fund? And these are all questions that are really hard to answer because they're so different for each individual person and what you're actually wanting from your experience with super. So it's quite a complex sort of a beast. There's a limit on the amount of money that can be put in, right? So you can't just funnel $600,000 into your super all at once unless you meet a few amazing special conditions. But generally speaking, you can only put up to $25,000 pre-tax and up to $100,000 post-tax into your superannuation, right? And there's also some bring forward rules and those sorts of things, which again adds to the layer of complexity. It's actually really hard to access until you're retired. So once you're 60 and permanently retired, age 60, you have unfettered access to your superannuation fund. Before that, you may need a condition of release such as premature death or death, which is one that you don't really want to have to use to access it. Another one is that you're totally and permanently disabled. And another one is hardship. Now, hardship was so hard to actually access that the government had to make a special provision for people to access their super with COVID-19. So if that gives you a bit of an idea on how hard it is to access superannuation, then I suppose it's a bit of a learning curve. So what are the key takeaways when we're talking about structures? Number one, the right structure may be a little bit more costly initially, especially if you're looking at a trust type of structure or a company type structure, but it will definitely save you in the long run. You may need to consider multiple types of structures that work in conjunction with each other to actually achieve the best results. So your financial planner, accountant, solicitor all might have different opinions on the appropriate structures for you. So you've got to make sure that they're all talking to each other. Your accountant might say that one thing is appropriate, and your solicitor might say another thing is appropriate, and your financial planner will say another. All right. Now, all of them may be right, but they might not be looking at it from the same direction, from the same, I suppose, perspective. Oftentimes, your accountant's all about saving tax, your lawyer's all about estate planning, and your financial planner's talking about how to hold investments and distribute them. So the key is to get them into a room with each other, get their arrows pointed in the right direction, in the same direction, working for you guys, get them to agree on the right sort of structures and implement those. All right. So does anyone have any questions before we move on to the next module? Obviously very conscious of time. Does anyone have any questions for me about structures?
No questions, no? Just loving the content. Keep going.
And if you do think of any questions, guys, of course, you can pop them in the chat function. I've put 2 in there already for you, Chris, for the end. So make sure you utilise that.
Great. All right. Cool. All right. So module 3, this is probably the sexier module out of all of them. Module 3 is all around gearing and compounding. It's also one of the shorter modules. And what we're going to do is we're going to go through the story of the tortoise and the hare. Now, everyone knows the story of the hare and the tortoise, and it's all around whether or not a sprint to the finish or slow and steady, and which one wins the race. Now, when we're talking about the tortoise and the hare, in terms of this aspect, we're talking about long-term investment strategies available using capital as the tortoise. Okay, long, slow burn in terms of adding capital over a long period of time, and the hare is everyone's favourite buzzword when it comes to investing, such as negative gearing or borrowing money to invest. All right, one is a sprint, and the other is a marathon. Okay, so when we're talking about whether or not it's appropriate for you, going into debt or not going into debt to achieve your investment goals is all about you guys. So it's all about you, and it also depends on the amount of time that you have and the level of risk that you're prepared to take. It's all about your goals and how fast you need to grow. Right, so what are some of the risks when we're looking at low, slow type investing? Well, it can be a low return, and if you don't invest appropriately, it can be a very low return over a long period of time. It can be really, really long time to actually build up the capital that's required. When we're talking about, I suppose, the hare or the debt beast, it can be a debt disaster. It can leave you with less than what you actually started out with, knowing a lot of money. Now, I suppose a bit of an example of the tortoise is I have a couple who are retired now, who are very close to my heart, who for 60 or 50 odd years put all their money into cash using the 4% rule. All right, and they invested all their money into cash, and they just built up their cash and cash and cash, and they've got a sizable amount now, but they're retired at 60 odd, and they've got about $600,000 in cash, and they probably needed to have actually invested a little bit more aggressively over that period of time. And so they haven't taken enough risk. They haven't done enough. And so they're actually in a position now where they're going to have to maybe keep working or go back to work to supplement their income or look at getting onto the aged care pension and those sorts of things. So they thought they were going to have more money than what they do. On the flip side, with a bit of a disaster or an experience that I've had with somebody in recent times, they had a client who bought out in a mining town and leveraged into a property in a mining town, thinking that it was going to absolutely take off. Unfortunately, it didn't. It was one of the Gladstone type properties, and the market's almost collapsed 40%. So unfortunately, they've been left with an asset that is never going to give them back what the debt is on it. So I'm going to run you through a really quick demonstration. All right. Now, what it is a ASIC Money Smart website compound or interest calculator. All right. Now, I'm going to just put a new share on. I'm going to show you the difference between the hare and the tortoise. Okay. Now, this is a simple compound interest calculator. It's going to give us some really easy numbers, and I use the Money Smart ASIC or the MyGov one because it's a well-trusted one as well. So there's no funny numbers when we're coming into this. So, Jasmine, can you give me a thumbs up just to make sure that I'm sharing the right screen there? No? Great, I'm glad I checked. How about now? Great, all right. So this is the compound interest calculator, all right? Now, if we're going to start with the tortoise, we're going to start with initial deposit of, let's say, $10,000. All right, it's not a mega amount of money. And let's say we put in a regular deposit of, let's say, $200 a week, or about $10,000 per year. All right, it's compounded annually. And let's say we invest it for 10 years and we get an after fees or a net return of 5%. All right, now over a 10-year period, we're looking at putting regular deposits in of $100,000 and we would have made about 32 grand, right? Plus the initial $10,000 deposit. So at the end of that 10 years, about 142,000. We go, okay, that's not too bad. But again, we're talking about the tortoise. We're talking about long, slow burn here. So we're not talking 10 years. Let's say, what are the numbers over a 20-year period? And all of a sudden, it becomes a little bit different. So there's been $210,000 of deposits, and interest has been at $147,000. Okay, that's a lot better. All of a sudden, the numbers are starting to really move here. And let's say you're a 35-year-old, and you've got 30 years until you're retiring. And the numbers completely change again. So it's all around the time in the market over a long period of time, with a small amount of money being put into these investments, $310,000 deposits over that period of time, and just under $400,000 of total interest. Now, at 5%, that's reasonably conservative. So what if we got it more towards the average growth rate for investments over a long period of time? And all of a sudden, the numbers change quite dramatically. So we've had the same amount of deposits, 310,000, and we've got interest now of 710,000, giving a total of $1 million over that period of time. So all of a sudden, the numbers change dramatically when we're talking about long, slow burn over a long period of time, with quite honestly a little bit of money. All right, so it's all about the time in the market when it comes to the tortoise style of investing. And this is where it's really important to start investing with small amounts, even from the age of 25 or 20 years old. All right? And someone who really brought that into a limelight, which is amazing, was Scotty Pape, who does the Barefoot Investor. And he talks about $100 a week. So hats off to Scotty Pape. Absolutely amazing dude for bringing general advice to the forefront and giving access to people, giving access to this information, because this is an absolute game changer for a lot of people. A lot of people think that you need $150,000 to start investing, but you can do it for as little as a couple of $1,000s and add to it over time. All right. Now, if you're wondering, well, Chris, what happens if we start with $150,000? I've got $150,000 to invest, but I haven't got 30 years. I've got 15 years, and I can add $10,000 a year into it. So regular deposits are $150,000. So you're putting in just about the same amount of money over that period of time, right? And you're getting a vastly smaller result. Okay, so it's all about time in the market. It's all about how long you can put it in there for. So that's a bit about the tortoise. Now let's talk about the hare. All right, this is where debt can be an amazing facilitator of wealth. It can be one of the best decisions that you ever make from an investment point of view. It can also be one of the worst. So if we're talking about the hare and we go, all right, well, let's not have 150,000. We're talking about $120,000 deposit for a $600,000 property. All right, we're not putting any regular deposits in. And we're 50 years old, and so we're going to hold it for 10 years. And it's a property type asset, and we can get, say, a 6% return on it. And that leaves us with in a similar position as a 30-year slow burn. Okay, so when we're talking about debt, debt can be an amazing creator of wealth, and it can create, if you're a 30-year-old and you're looking at this, it can create a lot of capital in the meantime, which you can reinvest and have 1.2 million. over a 15-year period, and all of a sudden you're creating an extraordinary amount of wealth. And this is what these are some of the structures and some of the ways that people utilize to buy that investment property in the second and the third and the fourth and the fifth. Not that I necessarily think that's a great idea, but utilizing debt to their advantage, especially in a low interest rate environment. All right, so that's a bit of the demonstration on the hare and the tortoise. They have some inherent risks, both of them, and which one is appropriate for you comes down to your ability to service loans, service debt, the security within your business and in your job, and your ability to earn an income, as well as how much time that you have. So that's all from me. That's the whole of the webinar. So would love any questions if you have any to fire my way and let me know.
Beautiful. Does anyone have a question?
Kristopher, that was really, really helpful. Thank you. Just your general thoughts on paying down debt versus investing.
Yeah, so I'm a goals-based advisor. Okay, so if a client says to me that the number one goal is to pay down their debt and be mortgage-free, that's where we funnel the bulk of the money. So that's the short answer. The longer answer is I also have an education piece with those people where we talk about the cost of debt at the moment, which if it's for your own home and it's about 2% odd, which is really quite tiny, and we talk about the potential in terms of investments and what you're likely to get from investing your money into an investment property or investing your money into shares or even investing your money into fixed interest type assets. We can often get almost twice as much in terms of investment returns. So it would have to be dependent on what they're after, what they're looking to do. But the long answer to that question is you're probably going to get a better return in this interest rate environment from investing your money than you are paying back to the bank, especially if you're on a long-term mortgage.
Cool. Does anyone else have a question? Otherwise, we can go to mine in the chat. Or why don't we go there? All right, Chris, first question from me is, what is the difference between a direct share, like in Commonwealth Bank, like you mentioned, versus a managed fund? The managed funds get talked about a little bit at the dinner conversation for me. And are those managed funds, are they less risky or more risky?
Ooh, that's a really good question. So the first part of the question is, what's the difference between a direct share and a managed fund? Well, the direct share is direct ownership within a company, within a business, and that gives you, it affords you certain rights and responsibilities within that company, such as the potential to vote within that company on annual general meetings and those sorts of things, and have a say in what direction the company is going. A managed fund is generally a pool of money that gets invested across a vast array of different areas. And each different fund manager will have a different way that they invest. Some fund managers might be high concentration type fund managers. Some fund managers might be emerging markets. Some might be high income. Some might be high growth. So there's a lot of different ways and a lot of different things when it comes to fund managers that you need to consider and need to look out for. In terms of inherent risk, that comes down to the different stocks that you're looking at. So if you're talking about emerging markets or international emerging markets, there's probably a lot more risk in that than owning a Commonwealth Bank share or a Rio Tinto or a BHP. Okay, generally speaking, from a point of view of the volatility, you probably will get higher returns within that managed fund, but the risk is probably greater. Okay, and that's because of what they're investing in is generally going to be higher risk. Now, if you have a managed fund that looks at the Australian top 300 and they're looking for high income generating type assets, it'll probably be more risk to purchase a high income generating share, such as one of the big banks or Woolworths or Coles, than it would be to put your money into a managed fund. So again, it comes down to the actual stock that you're looking at and the actual investment, the underlying investments as well. Does that make sense?
It sure does. Thank you. And I think you raised a really interesting point, which has really come to the forefront, I think, in 2020 about the income from shares is like, question mark. I think we traditionally have this thought of blue chip shares like the banks, like a Telstra, Woolworths, those sort of companies paying their dividends every year, but they've all I guess, had a haircut on those this year as well. So anyone that was banking on that dividend to come in the form of income may not be getting quite as much this year.
That's exactly right, and you raise a good term there as well, which is blue chip. And when it comes to income from these types of investments, and I used to run an income-heavy type of investment structure where we were looking at a lot of financials and those sorts of things, your big banks and that sort of stuff. And you might be surprised to know that a lot of these big banks were actually paying upwards of about 5.5% to 6%. Dividends plus franking credits. Some of them were getting that insane in terms of how much they were paying in dividends. And if you're wondering what a franking credit is, there's a really quick way to tell you what it is. A franking credit is where essentially the company that you're invested in pays the tax at the company tax rate for you. So it adds an extra benefit for you. So if you've got a 7% dividend or a 7% profit share from the business, they're actually going to pay the company tax on that. So you actually get a little bit more money. So that's all good and well. And people were investing, a lot of retirees were investing in your big banks and those sorts of things, expecting that the dividends are going to stay and remain really high because we have really highly profitable banks. But 2020 came around and all of a sudden, out of nowhere, which nobody could have predicted, the banks are offering an amnesty on a lot of debt repayments for a period of 6 to 12 months. And so what APRA has come in to do, and APRA is a regulating party, has come in and said, look, you guys need to hold on to some more of your dividends. You can't actually pay these dividends out because you might not have enough to run the business in 6 to 12 months' time. You got to shore up some risk. And so they had a delay on the dividends, and they've actually got reduced dividends now. So, and that all plays a part on the different types of values that you're getting from these shares, and and the roles that they actually play within the market as well. So income isn't ever guaranteed.
No, it's good point to make. I think we've got time for one last question. We are a little bit over, but I do see that Kara's put a question up in the chat. Kara, did you want to ask Chris about the debt snowball method? I've not heard of this.
So I'm a big Dave Ramsey fan. I don't know if anyone's heard of Dave Ramsey.
I haven't, no.
Oh, okay. Do you know about the debt snowball method?
Not from that terminology, no.
Oh, okay. In his sort of podcast, it's very American, kind of addicted to it. He says that you should pay off your biggest debt first. So find your biggest one and pay as much as you can off that and ignore your little ones and just chunk it that away. Once that's gone, then you go to the next big one and do it. That's the snowball method. What's your thoughts on that?
Yeah. That's actually a really good point. I was doing a webinar all around cash flow. As you might have seen in the Money Mastery model, we segment our advice into 3 major areas, and debt is a part of our cash flow area. Essentially, I disagree with that. I actually believe there's a bit of a debt pyramid that you need to look at, with non-deductible unsecured debt being at the very top. And you need to pay down that debt first. Now, generally speaking, that's stuff like credit cards, stuff like personal loans and those sorts of things. If they're small loans and you can get them out of the way, great. And when you look at non-deductible debt and you look at unsecured loans and those sorts of things, I always start, in that instance, highest interest first. All right. So if you have, and I'll paint you a picture from this point, Kara. If you have a $500,000 mortgage on your house, all right, and you're paying it back at 2.5% per annum, it's a big bill because it's a big wad of debt. All right. Now, let's say you've got a $10,000 personal loan because you've gone and bought yourself a jet ski, and you've got about $7,000 sitting against the credit card because you use your credit card a lot and those sorts of things. You have a car loan, and that owes about $30,000 on it, and that's on a 7-year type term. If you paying your debt and the biggest chunks first, you're going to try and pay off your home loan first at 2%, and then you're going to try and pay off your car loan, and then you're going to try and pay off your personal loan, and then you're going to try and pay off your credit card. Now, flipping that in terms of the amount of interest rate that you're actually paying within those debts, your credit card is probably anywhere between 13 to 20% interest. right? Your personal loan is probably around the 7% mark. Your car loan's about 5%, and your big home loan's about 2.5%. So in terms of how you're actually going to save more money over the long term and how you're going to free up more credit and be able to actually invest in other things more quickly, I'd actually start from the top down. And I'd go highest interest first, unsecured first, and then work my way down. And that way you have all your debt secured against something, and you have more money in your pocket over a long period of time. Does that make sense?
Yes, absolutely. Thank you.
No, all good.
We learnt a new term today, the debt snowball method. Love it, Cara.
Seriously, listen to Dave Ramsey. It's ridiculous.
we'll
Yeah,
find Dave Ramsey. All right, we might wrap up the webinar there. Chris, a sincere thank you. You put so much thought into this presentation. Really appreciate it. For anyone that was taking notes or wants to see this again, luckily, you know me, I record these webinars. So this will be up on my YouTube channel probably within the next day. So you can come back to this at any point. And of course, you know where to find Chris. He's Wealtheon is all over the social media, online, plus he's in our Entrepreneurial Parents Project group if you'd like to reach out to him there. So sincere thank you, Chris. That was fantastic. And then hopefully we can do the cash flow webinar next.
Yeah, fingers crossed. All right, guys, let me know if you have any other questions. I'll hopefully see you really soon.
Have a great day, everyone.
Thanks so much, Chris. That was awesome. Bye.
Thanks. Bye.